Hello viewers, welcome to Stock Talk. Hope you all are having a relaxing weekend. Today's video will share with you the most significant updates from the 5th Monetary Policy Committee meeting for financial year 2021 concluded recently. MPC meeting happens every 2 months, that is 6 MPC meeting in a financial year. Most important update, GDP growth rate is predicted to be negative 7.5% for the full financial year, an improvement compared to prediction at the end of Q1, which suggested GDP growth rate for financial year 2021 at negative 9.5%. Let's discuss this and much more in today's video. MPC is constituted of 6 members, 3 from within RBI and remaining 3 members are nominated by the central government. Now let's discuss the outcomes of the 5th MPC. Repo rate, that is the interest rate at which commercial banks borrow money from RBI, has remained unchanged at 4%. By keeping repo rate unchanged and low at 4%, RBI is ensuring that commercial banks in turn do not raise interest rates charged to end consumers. By doing this, RBI is aiming to fuel economic growth during these times of COVID-caused recession. Reverse repo has also remained unchanged at 3.35%. Reverse repo means the rate at which commercial banks can deposit their surplus funds with RBI. MPC has adopted an accommodative stance, suggesting that RBI could consider further lowering repo rate in the next MPC meeting to sustain and further fuel economic growth. Now here, you all may have a question as to why can't MPC further lower the repo rate to increase growth rate of the economy? It is important to note here that both MPC and RBI have been continually lowering repo rate for past many years to spur economic activity and economic growth in the country. However, RBI and MPC also have to strike a fine balance between economic growth and inflation in the country. Lowering repo rate results in increased money flow in the economy, which results in increased inflation, which works against the primary objective of the MPC, that is, to maintain inflation rate at desirable levels at all points in time. CPI inflation in Q3 is expected to remain at 6.8% and is estimated to remain around the same levels during the remaining part of the year. The current inflation is primarily fueled by supply-side bottlenecks resulting from COVID and due to increasing crude oil prices globally. Finally, few positives coming out of MPC meeting. Unlike the Q1 and Q2 GDP figures, Q3 and Q4 GDP is expected to be in positive range. Q3 GDP estimates have been revised from negative 5.6% to positive 0.1%. Q4 GDP estimate has been revised from positive 0.5% to positive 0.7%. Rural and urban demands are both gaining momentum, with most states moving out of lockdown restrictions. Business and consumer sentiments are showing optimistic trends. Fiscal stimulus from the government is moving away from consumption-led activities to growth-generating investments. Hope you like the crisp overview. If yes, please do hit the like, share and subscribe button. Also, we would like you to share the topics that you may want us to cover in future videos. As usual, we'll meet all of you tomorrow evening to share our predicted levels for Nifty and other stocks that could show positive momentum going into next week. Until next time, this is CA Divya wishing all the viewers of Stock Talk a fantastic weekend. Stay safe. Thank you.